This scalping strategy follows a really simple and repeatable method to take advantage of the 5-minute chart in crypto, forex, or stocks. It doesn't actually matter what you're trading, as we'll use the same technique to enter into trades based on a couple of technical indicators and nothing more. Hey guys, James here. I'll be using just 3 indicators in this video for a fast scalping strategy that you can use to go long or short to benefit from rising and falling prices. This strategy is by no means foolproof. It doesn't win every time, and you need to understand the pros and cons, which I will highlight throughout the video. Timestamps are in the video description alongside some other helpful resources. With this strategy, we need the ability to go both long and short, and so we're going to have to trade something like futures. If you're trading crypto futures, stock or forex futures, you can do that. Or if you want to trade it in the spot market, you can do that as well, but you're going to be looking to go long only. If you have a large trading account, then maybe you can trade around the edges, sell and go long. Actually, in the spot trading account, you can do that as well. But for this one, to make it easy to see going long and short, we're going to be trading futures. So come into Binance Futures. Now, if you're trading crypto, you might want to use Binance Futures. If you don't have an account yet, I'll put the link in the description, plus some other helpful videos on how to enter limit and market orders, take profit and stop loss levels as well. We're going to be using those. If you don't know what those are, check out those tutorials in the description below. We're going to get right into setting up the chart and talking about the indicators that we're using for this strategy. First thing I'm going to do is actually just make the chart a little bit bigger so we can see what we're doing for now whilst we implement these technicals. The first thing I want to do is actually change the chart timescale. So right now we just have time right here. You can change this to anything that you see fit. I'm going to use the 5-minute chart on this one. The reason being that the 1-minute chart is incredibly quick, and it actually means that inputting your orders can be extremely difficult. So I'm going to use the 5-minute chart. Although the technical indicators that I'm talking about, you can actually use them on different timescales if you want. So if you're more comfortable with maybe the 10-minute, 15-minute, 30-minute, then you can do that. What you can see on the chart right here are these indicators called Williams fractals. I'll talk about them in a second. The longer your chart, the longer the time period of the candlesticks, the fewer of these indicators that you'll get. That's not necessarily a bad thing. It's just good to know when you're choosing what timescale chart that you want to trade. Firstly though, I'm going to come to putting these 2 lines on the chart. You can see the red and yellow lines. These are called the EMA, or the exponential moving average. An exponential moving average takes the closing price of a time period. So in this case, this would be the 5-minute chart, the 5-minute candlestick that we just changed it to. And it plots out all of those prices on the chart in a smoothed out way. The difference between an EMA, or an exponential moving average, versus a normal simple moving average is that the EMA places more weight on more recent prices, and so the line will be different. We're going to put these on the chart right now then. So we're going to come up to technical indicator right here, and we're just going to very simply search for EMA, and you can see it right here, moving average exponential. Click on those to add them, and all I've done is just made them yellow and red. So we'll come into the formats right here. You can change these colors as you wish. Going to come to inputs, and you need to make sure that one of them is 20, as you can see right here, and then the other one is also a 50-day. I put 50-day right here. So I've got a 20-day in yellow and a 50-day in red. Or I should say 50 period. It won't be 50 day, it will be 50 period, 55-minute periods plotted on the graph, as you can see. These are going to give us the important information that we need in terms of the mini trend that we're trading. So we need these to work with our other indicator, which is called the Williams fractal. I suggest coming to a website like currency.com. There are others, and to learn more about Williams fractals. But essentially what Williams fractals do is show you an extreme point in a set of candles compared to the candles around it. Williams fractals will give you the most extreme price point of one of those candlesticks, and it will actually come up on the graph as a small arrow or a small triangle, as you saw previously. When you use Williams fractals, you can actually use them for different things. So you can use them for a detection of a potential stop loss. You can use them as areas of support and resistance, which is really important when you're trading. And something that we're going to be using them for, which is signal potential entry points. We're actually going to be using the Williams fractal as an entry point alongside our 2 moving averages that you just saw me put on the chart. To know more about Williams fractals and if they give us a bearish or a bullish sign, we can actually come over, thanks to currency.com, for this little graph here. But essentially a bearish fractal will actually be the highest fractal right here. So the fractal is the indicator that we get, but you can see essentially there was a move up and then a move down. This fractal would therefore be the bearish fractal because it is the highest point amongst other lower points. So for example, let's say this is the 20 period moving average that we just put on our chart. And then we have the other EMA, which is the 50 period right here. If the 20 is below the 50 period, then we could suggest that the price is in a small downtrend and that you only go short right here. Now what will happen is actually this will appear as a fractal or a small triangle for us. That's because this is the highest point, the others are lower, and it's really important that we use this with our EMAs because a fractal by itself doesn't give us much information whatsoever. We have to use it with some other trend information, so that's why we're going to be using it with the 20 and 50 period EMAs. On the other hand though, a bullish fractal appears like this. It's actually the lowest point out of a set of candlesticks. And again, we only use that with the 20 and 50 days. So let's say the 20 day or the 20 period moving average is right here and the 50 period moving average is right here. Because the 20 is above the 50, we could suggest that the price is in a mini uptrend right now. And of course, the fractal will be this most extreme point or the lowest point, and that's where it would come. Once that signal is there, that is our signal that we use to go long. We only go long because the 20 is above the 50. It's only just telling us the most extreme point. So the pro of the Williams fractal is that it's a very simple indicator, and it will also give us an arrow that we can trade from. The downside of a fractal though is that it actually takes 2 more candlesticks to complete before giving us an entry trigger, which means that some of the move may have happened already before we enter into our trade. Let's come and put Williams fractals on the chart then, just like we did with our exponential moving averages. You can see I've got them on already. You can come up to the technical indicators and just search for Williams right here. And then Williams fractal is here. You can click on that to enter it into the chart. I'm just going to come over to the settings of the Williams fractal. You want to keep it at a 2 period right here. I didn't change that. The style is very different though. When you enter Williams fractals initially, the down fractal will actually be red and not green, and it will also be a triangle down. That's because it is literally telling you that that fractal is the down fractal or the lowest point. That's absolutely fine, but for us, it's actually giving us a trigger to go long. And so we can just change and flip the triangle around to give us that long indicator. So rather than it telling us this is the down fractal, what we want it to tell us is, hey, this could be an entry point for going long. So just change it to green, triangle up. We want to keep it below bar, that's fine. In terms of the up fractal, it's the complete opposite. This actually comes as green and an up arrow initially, but for us, this could potentially be a sell signal. So I just changed it to red right here and then triangle down instead of triangle up. Press OK, and then we can see these on the chart right here. We have our green up, which is a potential long, and then our red down, which is a potential short. Now that we have our Williams fractals and our EMAs on the chart, you can use this cheat sheet for your positions. So when you're going long with one of these, what we want to do is wait for the long fractal indicator on the candlestick. It has to be below the 20 period EMA, but above the 50 period EMA. So it has to be within those two. Then what we do is put our stop loss at the 50 period EMA, and our take profit can be anywhere from 1 to 2 times our stop loss level. If you're trading forex or stocks, you're probably going for 1, 1.25, 1.5 times, only because those markets are far less volatile. If you're trading cryptocurrency, then maybe go up to 2 times because the inherent volatility of those markets is higher. You have a much higher probability of getting a 2 times or even more, a larger move in those markets on a short-term basis because of the volatility of those markets. Conversely, for going short, as you can see, wait for the short fractal indicator on the candlestick. Now this will be the opposite. So this will actually be above the 20 period moving average and below the 50 period. Because this is a short signal, we obviously wait for the 20 to cross through the 50 and be below it. And then we wait for that signal to go short. So our stop loss would be the 50 period EMA. And then again, our take profit can be 1 to 2 times the stop loss, depending on which market that you're trading. So let's come to the chart and see how this would actually work. So remember what we're waiting for when we are going long. So I'm just going to show you some long examples right here. We are waiting for the Williams fractal to actually come about between the 20 and the 50 period moving average. Because we've changed our fractals around, we now get these long signals, as you can see. So we can't trade any signals that are outside of either of these ranges. So you can see right here that there is a long signal right here, but this is not within the 20 and 50 day moving averages. This one is in, so this is potentially an entry signal. This one is outside, so we can't trade it. We have to wait for this entry signal to be under the 20 period and above the 50 period in an uptrend, of course, because we're going long right now. So we're waiting for that 20 to be above the 50. This would actually be an entry point for us. As you can see, we have this entry point right here. We can put our order on the chart right here. So we're going to click right here. Now, remember that the Williams fractal won't show up until 2 candlesticks afterwards. So we have the Williams fractal here. So actually the entry point for us would have been right here at the entry of this second candlestick. So we can go long right here. So we're going to enter at the start of this candlestick. We're going to have our stop loss right on the 50 period moving average. And then our take profit anywhere from 1 to 2 times. Let's just keep it simple at 1.5 times. So we have 1.5 times. You can see our risk reward 1.5. This is telling us that it would have been a profitable trade for us. So actually you can see what happened with the price is that it actually came right back down to the 50 period. And it didn't quite get down to our stop loss. So it would have been a very, very close trade for us, and we might have been stopped out depending on where we got in. But then you can see obviously the ride came up here, and then we would have been traded out with our take profit just on a wick up at this level. This is a 5-minute chart, remember, so this is probably about 40 minutes, 45 minutes an open trade, and you made 1.5 times. If we just look at other Williams fractals though, we can also enter them here. So this is actually another fractal. So remember, we have to wait for the fractal to be in between the 20 and 50 day to go long. And we also have to wait for the second candlestick. So that would be this candlestick. Let's go and enter again then. So we can come and enter on this candlestick right here. So we would have actually got the Williams fractal at this level. So we would enter right here, put the stop loss at the 50 period. And then with the risk reward, you can go anywhere from 1 times to 2 times. Now, obviously, the further out your take profit is, the less chance you have of actually getting out. So I'd recommend, let's say 1.5 or 1.25, something like that. So let's say 1.5 times. And there we have it. We have the stop loss right here and our risk reward at 1.5 times. And again, it would have been a profitable trade because you can see we pretty much would have entered right here and it just kept on going up. So we would have been taken out, and actually we would have been taken out right around here. So that was around 45 minutes to an hour's trade, again 1.5 times. Let's move over to a trade where it wouldn't have worked out though, and you can definitely see that right here. So we actually got an entry signal right here. Again, it is above the 50 and below the 20. Again, there was this one almost here as well. So you have the 20 period and the 50 period. So this and this signal both tell us to go long, but what you would have seen if we would have placed a trade on the chart at either of these 2 entry signals. So let's take this one. So we have 1, 2. So we actually go long right here. We place our stop loss at the 50 period, and then we have a risk reward a little bit above that. Let's say 1.5 again. So we can take this down to 1.5 right here. You can see that we just would have been stopped out. It would have come down, sold off, and bang, we would have got stopped out. So we had 2 winning trades and also a couple of trades where it told us to go long, and actually the market moved against us and came down. And what you can see here is actually that the 20 period moving average is actually coming way down. It actually crossed through below the 50 period moving average. So that definitely tells us that there was a short-term sell-off around this. And so those entry signals would have given us a couple of losses there. Let's also have a look at some short entry signals that you can see right here. So as the 20 period has moved below the 50 period, this would obviously be us only going short. And again, we have to take those Williams fractals. If it is above the 20 period and below the 50, that means we can go in and go short. So what we'll do is come and put a trade on as we have this entry signal right here. So remember, it's going to be the second candlestick. So we open a position right here and our stop loss is above our price now. This is the 50 period, and then our price target, we can just do 1.5 times again to make it easy. This would have been a good trade for us. You can see that as soon as we entered, it was pretty much moving down. It never got up to the 50 period, and we did in fact make our profit around about half an hour, 20 minutes later. This would have been a very good trade for us, and actually would have been a few different trades. So you can see 1, 2, 3. Now, this begs the question, if you are open in one trade and you are winning, do you actually see more triggers and actually add to your position overall? Well, there's no definitive answer here. It's really up to you. You can see that actually we get 3 triggers right here. And what you could have done was enter at this trigger and then add to your position here and then further add to your position here. On this particular occasion, you would have done really well and actually won on all 3 of these trades. So you would have had a much larger position and won. So it would have worked out for you. However, we do have to understand the risks of doing this. When you add to your position and grow your position, obviously the risk of loss also increases. What we can also see is that these are progressively coming down, meaning that our entry price is also coming down. So potentially if the price does shoot up, we do have a slightly different risk position. So should you add to your positions, this is down to personal preference. Let's enter another trade then as time goes on, and you can see some big changes and differences here. So we get the next couple of signals, one here and also one to the side of it. We'll go and take a short position on these. So we'll click this and then we'll come and take these short positions. So remember, this is the highest point. This is the entry signal right here. We have our stop loss at the 50. Then we can go and have our take profit, let's say 1.5 times again. Now what you can see is a huge move to the downside here, but right when we enter, we can actually see that what happens is the price does move down, but then you get this very weird price movement and price action here. So we actually do get stopped out right here. So you can definitely see that the price during this time period, it actually wicks up to this level. And even if we didn't get stopped out here, we'd actually get stopped out around this level. So these 2 candlesticks actually above our stop loss. This would have been a losing trade for us, but it would have been a very frustrating trade because you can see after we got stopped out right here, this huge move to the downside in the chart. And obviously if we were short right here, this would have been an incredible move for us. And that would have been a fantastic trade. Of course, we only would have made 1.5 times according to our strategy. But from what you can see with our 3 long trades and our 2 short trades, is that this strategy does work best in a trending market. So if you have a clear trend where the trend is just going up in a very nice fashion, and same on the downside, then you're going to have more opportunities to enter your trades and you're going to be more profitable and have more winning trades overall. When the market is extremely volatile or moves in very unpredictable ways, like we're seeing around here, then obviously it's harder to make those profits. But that goes with a lot of strategies, so just to keep that in mind. And with that, I do want to touch on some of the positives and negatives of this strategy in particular. You can see here it doesn't work in extremely volatile markets. So if you have a big pump or a big dump, this strategy is just not going to work for you, and you're going to have to maybe do another type of strategy, maybe breakout trading or just trying to trade on volatility. Sideways markets also may provide more false entries and not get those moves that we need to actually come out of our position. Also, a potential downside is that it requires very fast hands to actually input these orders. I haven't gone through inputting the orders right here, as I assume that you know how to input limit and market orders and take profit and stop loss orders with futures. If you don't know how to do that, definitely check out the videos in the description that go through step by step how to input orders. But even with the 5-minute chart, you do have to put these orders in very quickly, otherwise the price may move away from you and you won't actually enter. Bots may be an easier option and an easier choice for you. This is a completely different strategy, but essentially you just give the trading bots an amount of money and they'll go ahead and do a grid strategy for you, taking advantage of price volatility. It's completely different, but you may want to do that. KuCoin and Binance do have trading bots. I have videos to them. I'll put them in the description and link to Binance and KuCoin if you want to go ahead and check them out. Also, a downside is that fees will eat away at your returns. We're trading in quite small tick movements here, so you're going to be paying relatively more fees because you're trading more often, so just to keep that in mind. A positive though for me is that you only have to trade for an hour or so a day with this strategy. If you don't have a lot of time for fundamental or technical analysis, just turn your charting system on. As long as you have the right setup with both the 20 and 50 day and you're getting these indicators from the Williams fractals, then you can go ahead and enter trades, maybe half an hour, 45 minutes, an hour and a half. You actually are going to get some trading opportunities to go with. So you've seen the potential strategy, the upsides and the potential downsides of using it overall. Do subscribe for daily helpful crypto content, and I'll see you in the next one.